The housing market has experienced a rather unexpected turn in the recent years. New reports are starting to reveal significant cracks in some of America's largest cities. Empty office buildings in San Francisco are expected to be sold at an 80% loss. Furthermore, Blackstone has once again restricted withdrawals from their real estate fund. To start, before we delve into the latest details of the residential housing market and the areas experiencing significant declines, let's first discuss what experts are calling the next potential market disaster: commercial real estate. This term encompasses properties used for business purposes, such as office spaces, warehouses, retail shopping centers, and restaurants. Essentially, any building that is not a home or apartment. In most cases, these types of buildings are not owned by the end users themselves. Many businesses prefer to rent rather than own the real estate they operate from. Consequently, there is a vast $20 trillion market of hedge funds, investors, and real estate investment trusts, whose aim is to find undervalued commercial properties, improve their value, and secure tenants that can attract more customers to the area, thereby increasing their worth and generating profits. These commercial real estate deals often involve large sums of money, with groups of investors pooling their resources for the purchase. Everyday investors can also participate in these opportunities through publicly traded companies like Simon Property Group, Realty Income Corp, and other similar options, which provide a means of earning passive income. However, commercial real estate differs from residential real estate in several key aspects. While residential properties can be financed with a 30-year fixed-rate mortgage, commercial real estate loans typically have a fixed term of 3 to 7 years. After this period, the loan adjusts to the prevailing interest rate. Additionally, commercial real estate loans have amortization schedules, typically longer than the original term. For instance, instead of owning the property outright after 15 to 30 years, as is the case with a normal house, there may be a balloon payment due to year 7 in commercial real estate. Consequently, if property values decline, owners may end up owing more of the building than its actual worth. Furthermore, interest rates have significantly risen in the past year. As a result, a considerable amount of real estate is set to be reset at current interest rates, potentially leading to a severe property crisis. For example, 25% of all office building loans are coming due in the next year, with interest rates now 5 times higher than they were a year ago. This increase in ownership cost may have substantial implications. Moreover, commercial real estate valuation relies on 3 main factors: the land and future development potential, the cost per square foot required to recreate the same building today, and most importantly, the building's income generating potential. The more money a property can generate, the higher its value. However, many properties are currently experiencing declining rents, facing competition from treasury bonds that offer safer investments with guarded returns. Investors are primarily concerned with maximizing returns while minimizing risk and effort. When interest rates were at record lows and real estate offered a return above those rates, it seemed like an attractive investment. However, with treasuries now offering around 5% returns and other financial options becoming more appealing, real estate must provide higher returns to remain competitive. As a result, result, the decline in rent for commercial properties, combined with upcoming interest rate resets, creates a perfect storm for a commercial real estate crisis. The situation is also worrisome on Wall Street, as noted by Fortune. For example, Blackstone, which operates a real estate investment trust allowing investors to pool their money to purchase various assets, has been limiting investor withdrawals for 6 consecutive months. This limitation stems from the fact that real estate investments are illiquid, making it challenging to return investors' money on demand. Similar sentiments are observed in the housing market, with Invitation Homes scaling back its purchasing activities due to reduced financial viability and expectations of further market decline. Realtor.com's latest housing report provides additional insights into the current state of the market. The report reveals that there are 48% more active listings available compared to the previous year. While this may seem significant, it remains a fraction of pre-pandemic levels. Moreover, sellers' interest in listing homes for sale that not improved in any region, likely due to homeowners' reluctance to give up their existing mortgage rates. The report also indicates that the typical home spent 49 days on the market in April, which is 17 days longer than the previous year. However, homes still spent 12 fewer days on the market in April compared to the average April between 2017 and 2019. In terms of price fluctuations, research from Block Night reveals that Columbus, Ohio, Hartford, Connecticut, and Worcester, Massachusetts saw the largest price increases, while Austin, Texas, and Provo, Utah experienced the sharpest one-month declines. From peak values, significant price declines have been observed in areas such as Austin, San Jose, San Francisco, Seattle, Phoenix, Las Vegas, Boise, Stockton, Sacramento, and Salt Lake City. Considering these factors and their potential impact on everyday investors, it is crucial to approach real estate investments with caution. Properties should be viewed as long-term holdings, lasting 5 to 10 years or more, as selling can be a time-consuming process with uncertain profits, regardless of whether you invest personally or through funds like Blackstone. Additionally, it is worth noting that not all real estate sectors are at risk. Warehouses, industrial spaces, retail spaces with low vacancy rates, and hotels experiencing record revenues are examples of areas that are faring well. Like and subscribe for more informative content. Thank you for watching.